Let's talk. And Harold, today, in terms of talking, the topic is going to be CRUTs, Charitable Remainder Unitrusts, and Roth conversions.
CRUTs, that's quite an acronym. I have one, as you know, and just to, siphon off a little of your inheritance to go to charity. But like talking about these.
Crushing news for a good cause, if you will. No, we're excited to dive into these. We're kind of building our library here of planning videos, and where we're really going in depth into a sort of hypothetical scenario for listeners of our content.
I think your case study you've got here is a really good one to illustrate some of the planning possibilities.
Yeah, so we'll have some tables that are pretty in depth, and we're going to get into some detail here and really kind of walk you through it. And excited to do that, and just hopefully get some content out there that people can look at and see, think, does this kind of apply to my situation, or is this something I might want to do, in my retired years?
We can't, in this context, do enough analysis to lead somebody to a decision, but I think we can illustrate what the concepts are, and then, if they need to analyze something, we can certainly sit with them and do that.
Gives them an idea of the type of things we do as wealth managers.
Sure.
Yeah. So we're going to pull up a little table here that's going to set the stage a little bit with some facts of just kind of how we're building this. This is Charitable Cynthia, Harold. Okay. And I'll just kind of run through these. Cynthia, a hypothetical person that we've come up with, is 61. She's recently retired.
She's married to Charitable Rick.
She's married to Charitable Rick, who's a little younger, 57. Neither of them are of RMD age and don't want to withdraw from their retirement accounts, right now. Cynthia has $2.2 million in a brokerage account.
Not bad.
Yeah, $200,000 of that is diversified amongst a lot of holdings, but really has some concentration risk. She's got $2 million in fair market value of NVIDIA stock, which over the last 10 years or so is something we have seen.
That's been a nice place to be concentrated.
Here and there.
That's not a recommendation, of course, but...
The unrealized gain is $1.6 million. Yeah. So if she's going to sell those shares and wants to diversify them, she's got a
big capital
gains tax hit. She's retired. She rolled over her 401k from her.
I think, just to interject, that's kind of a key foundational principle. One of the real attractions of a charitable remainder trust is if you happen to have some appreciated stock positions. Those, it's not required, but it sure makes the planning
for sure
fertile.
It's a little, it juices it for sure. Rolled over a 401k from her old employer. She was with them for 25 years, so that account has a balance of $2.4 million, all pre-tax. Mm-hmm. Rick also, just jumping ahead to 0.5, is retired. He has $1.5 million in a similar account. They have 3 children, ages 22 to 28. Kind of that's top and bottom. They feel confident they want to give a meaningful amount of money to the Houston Zoo.
Okay,
that's kind of their charitable interest.
I like the zoo.
They're not really sure. We could go in a different video about your favorite exhibit or animal to see there, but maybe not for today. But
I think one thing that's critical that you just don't want to gloss over is their kids are grown and they judge them all to be well launched and stable. They want to leave them an inheritance, of course, but they're not. Yep. The kids appear to be stable and on their own and supporting themselves.
Yeah. No, you hit 7 right there. They would like to leave behind tax-advantaged assets for their children. And 6, 0.6, they want to leave that money to the Houston Zoo, but they're not really sure how they want to do it. So those are kind of their 2 objectives. They're going to take...
And I think it's important setting the stage. There's nothing magic about these charitable strategies. You need a true charitable motivation. As a foundational element, I think, for these to work.
Yeah.
The tax advantage is quite pronounced, but taxes aren't 100%. So you do need some true motivation that you want to benefit a charitable cause.
For sure. They're going to take Social Security at full retirement age, 67, and they want to spend $100,000 this year in their first year of retirement.
You can see how they got to where they are. They're pretty frugal in their spending compared to the dollars they've built up. They have saved a lot of money.
Yeah. So here's a little table, and what we're going to do here is illustrate how a CRUT, a gift to a CRUT, might work. Okay. this first little number that matters is the $2 million number. Pretend that that's her giving all of the NVIDIA shares to this charitable remainder trust. You might kind of describe how that would work.
Yeah, so a trust, by the way, doesn't necessarily mean you could have a formal trustee like a bank or somebody that would run this, but that's not required. You can set these up fairly informally with your lawyer and trustee it yourself.
Mm-hmm.
But a charitable remainder trust means that, Cynthia and Rick have opened an account. They've put those NVIDIA shares in there. They can't get that money back, all right? But they've named a charity, the Houston Zoo, at the end of that trust term, and the end of the term for them will be when the second of them dies.
Mm-hmm. We're going to illustrate that as a period of 25 years.
Okay.
For illustration purposes today.
And they're going to receive, the zoo will receive whatever's left in the trust, but for the remainder of their combined lifetimes, they're going to draw an income off the trust every year.
Yeah.
5% of whatever the value of the trust assets
So talk
are.
real quick, though, that $2 million amount, what happens the second those NVIDIA shares hit the trust account that they've created? What do they do?
They're now in a qualified, what the IRS calls a split interest trust for charity, meaning they can sell those shares the next day at no capital gains tax.
Yeah.
Diversify that, and generally
Buy 100 stocks if they want to.
We would recommend keeping it in stocks because that is going to give them the most tax-advantaged income stream coming back from the trust. But it could be a combination of stocks and bonds. It doesn't have to be all stocks. But the point is they've gotten away from the single stock exposure to one company.
Rid themselves of that concentration
and they've
risk.
diversified it, and they've paid no tax.
Right.
But so there's more money at work producing income that they can draw. And
that stock was a third of their portfolio, pretty much. It was meaningful.
And, and as your chart illustrates, if they're withdrawing 5% and the portfolio's growing by more than 5%, their income is going to ratchet higher every year.
Yeah, so just to kind of run down the graphics here, we're going to assume an 8.5% per year total return.
That's kind of a market return, really.
We've really probably, I would call it conservative. If you're in all equities, you're probably going to get more like 9 or 10. So we're just conservatively haircutting it there. On the right side in the blue, we're going to illustrate 5% of that return of the 8.5 coming out as income to Cynthia and Rick to fund lifestyle expenses. And as you said, that's an income stream that's going to grow at a rate that generally is outpacing inflation.
Yeah.
So that's a good formula. And then on the left in the green, 3.5% per year. We're just illustrating as accumulation of value in the trust. Your holdings are going up in price, and so
you're making 8.5. You're paying out 5. You're growing at 3.5.
That's right.
Yeah.
Talk to us about. Is there anything magic about that 5% number?
Well, the 5% is an IRS statutory requirement.
Yeah.
You can't have one of these at anything less than 5%.
Yeah.
You could specify something higher than 5, if you wanted to, but if 5 is kind of a nice middle ground because you're getting a very generous income flow. And if we can't get into all the, the
minutia.
The minutia that's in the weeds, but if you manage the investment strategy and the trust correctly, that income is coming out to you in a form that continues to be taxable at long-term capital gains rates.
You're kind of leaning into qualified dividends there.
Yes, right. Yeah. And So the benefit at your death for the Houston Zoo in their case is growing.
Yeah.
To be a very substantial sum.
Well, just to kind of bring it down, their income stream over 25 years more than doubles.
Yeah.
It's 2 or 2.5x what it was at the end of 25 years, which is great. And the charity is getting over 2 times as much as the starting amount. So that amount would go to the Houston Zoo.
You asked about the 5%. I might just mention, and we can't go through all the iterations and versions of these. There are some nuances to creating these where if you wanted the income to be lower for a few years, there's a version of the Charitable Remainder Trust you could create that's tied to the net income. You could suppress the distributions in some early years and have them become higher at a later point.
No, we have kind of oversimplified some of this just to make it sort of apples to apples, make it easier to present.
Well, I think our point is just to get the idea
across.
There's a lot of details that obviously work into this.
This next slide, we're just going to cover kind of the tax benefits, and we've sort of made it a little simpler here in a few ways too, just for presentation purposes. But we've already kind of touched on this. The capital gains tax avoidance on the NVIDIA gains to diversify out of it is significant. I mean, that tax bill, assuming long term, would have been,
$250 to $400,000.
It's not nothing. I mean,
so that's the beauty of this, is that you can diversify a concentrated position or two, get it diversified, and draw the income without diluting your base that's earning income.
Yes.
I mean, they've got $250,000 to $400,000 of extra money working to generate income.
And then maybe even more meaningful, the current year charitable deduction.
Yes.
You want to talk about that just for a second?
Well, it's complicated. Suffice it to say, when you create one of these, because the way the IRS looks at it, because you have irrevocably committed at the second death, in this case, at Rick or Cynthia's death, for the money to go to charity, the IRS gives you a tax deduction in the year that you create this. Now, you don't get to deduct the full $2 million in their case. It's really actuarially determined based on interest rates and your age. At their ages, early 60s, probably about a 35% deduction.
That's what we're assuming.
Is about the max you could get. But if someone is a little older, if they're 65 to 70, that deduction would tend to be a higher percentage of the value of what's contributed to the trust.
Yeah.
And we're kind of showing it like they can just deduct it all in 1 year. There's some rules around that. In real life, you may have to plan to fund the trust in 1 year, but take the deductions over a couple of 3 years.
Yeah.
Depending on your other income and some things.
We're going to show
like
some
that.
tables here that kind of simplify that a little bit.
We're shortcutting those details for
right.
purposes of simplicity here today.
So let's look at that.
Okay.
Let's look at some of these tables that we have just to illustrate kind of really what we're going to get to is the Roth conversion benefits that we're going to use that deduction.
You can pair the deduction.
We can pair the deduction. We can maybe do some Roth conversions for Cynthia and Rick.
Right.
That balances their other objective, which is they want to leave tax-advantaged, tax-free assets to their kids, and they can do that via some Roth conversion. Yeah. So let's put a pause on the Roth for one moment. What we're going to do right here is just extrapolate a value of their pre-tax IRA balances out to kind of their death and the 10 years following. For people who are watching along, when you die and you leave behind an IRA account, whoever receives that IRA as a beneficiary, Harold, has 10 years to draw it out.
That's right.
Whether it's a Roth or whether it's a pre-tax account.
When you receive my massive account at my death, you're going to have to draw it down.
It'll be like,
years.
$25.
$25.
And so I don't pay taxes on that if you haven't Roth converted it. So, but what we're doing here is we're just going to take the value of $700,000.
Which is that we're assuming they've got that much deduction that they could cover that amount of retirement account to convert it.
And so we're gonna just illustrate here in this blue table that they don't do a Roth conversion first.
Yep.
Okay, so we're just gonna take that amount. We're gonna grow it at a compound annual growth rate of 8% for 25 years until they die. And so 25 years later at that death, just that little segment of money is worth $5.38 million.
Compounding is a wonderful
compound interest. And so then what we're going to do is we're going to illustrate at the date of the second to die, we're going to illustrate a 10-year schedule.
So now their kids are getting this.
Now their kids are getting the money.
The 700 that they could theoretically convert, it's become 5.4 million. Their kids are getting that, and then
these next 10 years that you see on the left here, those are all that's all their kids, right? And so if you're kind of moving to the middle of the table there, they have to start withdrawing that out. Now, we've done enough of these to know that really systematically withdrawing them down is kind of the best way to do it.
Well, you have a better chance of keeping the withdrawals in some bracket other than the top bracket.
Yeah.
And so it can be advantageous to spread it out.
And again, a lot of interplay here. Remember back to the facts. Their kids at the time of this CRUT gift were in their mid-20s.
Yeah.
25 years later,
they're in their
late 40s, early 50s.
60.
They're probably in one of their highest earning
Right.
or some swath of their highest earning years, right? And
So
so
having to take this money out and
They're having
add
to
it on their
take it
tax
out.
return is maybe pretty painful.
what we've done is we've just assumed a 30% income tax rate.
Right.
And so you see the column of withholding there. They're taking this withdrawal, they're having to withhold 30% of it, and this net withdrawal
And
is
just for context, today the maximum federal rate is 37%.
right.
And that's lower than it has been in a while.
Mm-hmm.
So 30% is maybe, if anything, possibly understating the tax burden.
Yeah, it could be a little
kids would
higher,
have.
especially at
Yeah.
those ages.
Getting a
So,
regular IRA.
but yeah, we've got the withholding at 30, and then we've got net withdrawals each year. Okay, and they just systematically take that account down until it's at zero. At the end of year 10. And what that basically amounts to is net withdrawals of a little over $6 million.
Yeah.
If you're following
After
along
the
there.
taxes are withheld.
Now, to be fair, we're going to show you a scenario that we think is more favorable in the next table. But to be fair, we're also going to take those withdrawals each year and reinvest them into a brokerage account, an after-tax account, right? We're not just going to assume that
You're trying to figure out at the end of the 10-year period how much money do the kids actually have.
Right.
So we can compare that to the Roth.
we're trying to make it as apples to apples as
Right.
possible. So rather than say that these net withdrawals are going to be spent on a Harley Davidson or a Porsche or a house, which in reality could happen, we're just going to say, no, these children are building up their nest egg. They're still working. They don't need the money. They're going to reinvest it.
Right.
And so we're then going to assume on the far right, withdrawals reinvested after tax, that's also growing at a rate of 8.5%. Now that's in a brokerage account. So we're going to just assume an embedded tax realization of 20%.
Okay.
Off of the 8.5. So really that boils down to about 6.8.
Yeah.
If you're kind of embedding some tax realization
Right.
there. And so after all of that, where you kind of get is, if they don't make the Roth conversion, if they just had pre-tax balances, Cynthia and Rick, they have a little $7.939 million.
So let me just be sure I'm
on that
following you.
value.
Where you're going with this is you're saying because they created the charitable trust, they've got available a $700,000 tax deduction that they could use to convert some retirement account money to a Roth and not have to pay tax.
Right. That's what we're about to
And
show.
so we're trying to figure out if they don't do that, what's the ending result for their children after 10 years of withdrawing what that 700 could have become.
been. Yeah.
And now you're going to say, well, let's assume they do convert it.
Let's assume they do convert it. We've gone through kind of the base,
okay,
if you
got
will,
it.
and it's close to $8 million.
All right, the $8 million looks pretty good.
Looks pretty good. Yeah, I'll be inheriting nowhere near that
That's
much.
that's 11x
from you.
on the 700.
So the green table is going to illustrate that same amount, but it's taking that it's using that deduction to convert their pre-tax balance to a Roth IRA.
Right.
At $700,000. On the left here, you see it grows at the same rate 25 years later. So at their death, it's worth that amount is worth
$5 million for roughly
3.8. Yep. But a relatively simple table here. That's all. It's all in the Roth IRA, so it's all free of tax.
Right.
It's going to grow tax free. It's going to be withdrawn tax free, 100% of it for their children. So in their scenario, they wouldn't do those systematic withdrawals, and maybe you could explain why.
Well, if you've got money in a tax-free pot and you don't need to spend it, you want to keep it in the pot growing as long as possible.
Right.
The government gives you 10 years. So let it run. Keep the dollars invested.
Absolutely. And so that's what we're going to illustrate them doing.
The 5.4 becomes in your table about $12 million.
Becomes 12.1.
And then when the alarm bell rings at the end of 10 years, you can take it all out with zero tax.
The reason this table is simpler is because we don't have to do any tax withholding or anything.
Right.
That right side box just illustrates that their heirs would be withdrawing $12.1 million.
So 12
all
after
free of
tax
tax.
versus 8 after tax. I think it's a 50% gain in terms of the heirs' money.
Yeah. And again, just kind of playing the long game, using, when a client's circumstances come together like this, it's our job to kind of identify, well, you have this over here and you have this other objective over here.
How can we?
They're both important to you, but how do we put them together?
How do we marry that up? Right.
So we just thought this would be a really valuable little video today. I'll kind of give you the last word on it if you want.
Well, I'll circle back. I mean, I think this is something that has come up a few times in our experience where you've got both objectives present as goals for the client. client. It's very common that people, all kidding aside, people always joke and say, I want my last check to bounce, and I'm not really managing my portfolio to benefit the next generation and my children. I think in reality, though, whether people admit it or not, that's always on their mind. So that goal is usually there, maybe secondary to their own security, of course, and that's appropriate. What's there less is the charitable motivation. Not as many families are going to have that, and maybe don't have the kind of buildup of money that they feel like they can afford to do that. But where both of those things are present, these marry up really very well.
Really very interesting.
So I think this is a great example of where if you just are thinking a little bit outside the box, there's a lot that can be done.
We like to think outside the box here with clients, and that's kind of what the point of this content is for, is just to give prospective clients and our listeners a little bit of an insight into sort of the things we look at as a firm. So, we said we were going to talk. You certainly did more talking than me, to be clear.
As is usually the case.
Which is usually the case. But yeah, we're Precedent Wealth Partners. Let's talk. Thanks for joining us.